Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive uses natural and artificial intelligence to educate investors and provide actionable insights for all markets, from rates to FX to commodities. For our latest insights, visit macrohive.com. Before I start my conversation with this episode's guest, I have 3 requests. First, please make sure to subscribe to this podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave some nice feedback and let your friends know about the show. My second request is that you sign up to our free weekly newsletter that contains market insights and unlocked content. You can sign up for that at macrohive.com. Finally, and my third request is that if you are a professional or institutional investor, do get in touch with me. We have a very high-octane strategy and analytics offering that includes access to our world-class strategy team, market views, AI models, and much, much more. You can email me at bilal@macrohive.com, or you can message me on Bloomberg for more details. Greetings and welcome, David. It's fantastic to have you on the podcast show.
Bilal, thank you for having me.
Now, before we go into the meat of our conversation, I do like to ask my guests something about their origin story. So, of course, you've had a long career in finance, but when you were at college, what did you study? And was it inevitable you'd end up in finance and then on the buy side as you've ended up being?
Well, it really started with undergraduate school and trying to sort of feel my way around what I would like to do for a living. And finance courses at my undergraduate school were very appealing to me. The ability to make money in the stock market I thought was fascinating, and my focus was there, but it really didn't accelerate until I ended up at Columbia Business School. Now, I applied there specifically because that's where Warren Buffett went to school. That seemed to be a reasonable thing to do. And also Benjamin Graham, the father of value investing, had taught there. And I had been involved with a small investment club after I got out of undergraduate school. And we were utilizing value investing techniques while we were running that investment club. So I was already sort of ingrained in the philosophy of value investing by the time I showed up at Columbia Business School. So that was really the kickoff that got me interested in investing. And as I went through the academics that were offered at the time, much to my surprise, I found the school had evolved into an efficient markets program, which was frustrating, especially given how much it cost and what I was there to do. But it worked, as many of these points of adversity work in pushing me further into finding different ways of learning about and executing a value investment philosophy. There were influential accounting professors. There were some influential professors in security and in the security analysis classes. And much to my surprise, the most influential teacher was an adjunct by the name of Joel Stern, who was a management consultant of all, places to find influence on your investment career. But a little bit of a different management consultant, one who was less focused on fixing the operating procedures of a business, but really focused on understanding what drives economic value. So he and his partner, Bennett Stewart, ran a management consultant, and Bennett had written a book called Quest for Value, which still sits on my desk here, and I suggest everybody have a read through it. And in that book, they coined what's commonly referred to as EVA, economic value add. And just to clarify and make it simple, EVA is what helps define the difference between a good business and a bad business. A company that earns above its weighted average cost of capital is effectively a good business, and those are worth more than bad businesses. Now, what is the weighted average cost of capital is an academic debate that we don't really need to engage in. But basically, companies that have high returns and have the ability to sustain and especially grow those high returns are businesses that are more valuable, and they should be favored. And that's kind of an eye-opening concept to have at a very young age. And to note that, all companies trading at 8 times earnings are not necessarily alike, and some deserve to trade at 8 times earnings and some don't. And the ones that don't are the ones you want to favor because they're going to help you generate wealth over a long period of time. So my academic background, with the focus on finance accounting, was really very formative and helpful in me developing my investment philosophy.
No, that sounds great. And then, I mean, talking about value, one question is, how do we define value investing? Because I think it means different things to different people. And, you mentioned Warren Buffett. When I read some of his investments, it feels a bit less like value and more like quality investing. Maybe it's sort of semantics, but at least in kind of quantitative strategies, people make that distinction on factor investing. The other one is that you mentioned metrics, and you talked about PE ratios and economic value add. I mean, how should we think about metrics?
Well, I wouldn't first to your first question, I wouldn't conflate, finding a good value with a quality business. The value of a business is the present value of its future cash flows. And a business with higher returns and higher growth is worth more than a business with lower returns and lower growth. And if I take that simple concept, the value of a business is the present value of future cash flows, the fundamentals of value investing is, once you make that calculation, which is not as easy as it sounds to get right, you come up with an estimate of intrinsic value, or the value of the business. Those are the same two things. And you never buy at a fair price. You buy at a significant discount to a fair price. That is the basic fundamental principle of value investing. And why do you do that? You do it because it provides you with dual benefits. So let's say I have the prospect of buying two businesses. They both grow between 5 to 10% per year. They both have pretty good returns. And one trades at a fair price and one trades at a significant discount to a fair price. So the return prospect on the former is 5 to 10% per year. You have a fair price, and the underlying value of the business is going to grow at 5 to 10%. But the latter, let's say it trades at a 30 or 40 or 50% discount. When time goes by and the underlying value of the business starts to grow at 5 to 10%, and if you do your job correctly, you've properly identified that this business is undervalued. If it's 50% undervalued, it's going to revalue 50% to that fair price. These are the very simple and easy to understand concepts behind value investing, but most people can't get their heads around it, right? And that doubling of the share price is where you generate alpha, right? That is how value investors generate alpha. It's finding a business that is worth 20 times earnings because it's growing and it's got high returns and it generates cash and it's got a good management team and a good market position. It's worth 20 times earnings, but it's trading at 10 times earnings. And that revaluation from 10 to 20, that drives your excess return. Now, there's also another aspect to this, and I call it the 2-for-1 deal. And who doesn't love a 2-for-1 deal? Is that it also helps you manage your risk, right? Because if instead of being worth 20 times, let's say, maybe you get the earnings power wrong, or, the government changes the rules, or, life never happens in a linear fashion. Something goes wrong, and the business ends up being worth 15 times earnings instead of 20 times earnings. Because you've paid 10 times earnings, you've avoided a permanent loss of capital, right? And on a very micro basis, people talk about, how do you manage the risk in your portfolio? Well, if you own a series of good businesses, we haven't talked about, balance sheets, but we love strong balance sheets. And that's, one of the key fundamentals that Ben Graham pushed for. And you're buying it at a price that allows you to avoid a permanent loss of capital. You're doing that in aggregate for all the securities in your portfolio. That is an extremely powerful tool that allows you to manage. There are other ways, but that one micro-based analytical process or mix of characteristics that you're looking for in a security attached to a business, that is a very, very effective tool to manage risk in your portfolio.
And you mentioned things like management quality. Some of these measures you're looking at to understand the intrinsic value of a business, are some of them quantitative? So PE ratios, price to book, and all these sorts of things. Some of them are presumably qualitative. I mean, do you have some kind of dashboard that you look at, or how much of it is very, I don't want to mean it in a bad way, but kind of intuitive? Like you build up with the experience, and you have a good kind of sense of whether a business is good or not.
Yeah, the only dashboard I have is in my car. But you can get clues as to where you might find an undervalued security, right? Something that trades at low price to book, right? Something that has a low PE ratio, something that has a high dividend yield. It's nice to mix and match things. That maybe a company that had a high return on capital employed over the last 5 years and now trades at 10 times earnings. There's so many ways to skin the cat, to use statistics, which are easy to get in FactSet or Bloomberg or whatever tool that you have to try to connect the dots. There's lots of different ways. We look at 52-week low lists, but I have to tell you, Bilal, the way that we find businesses that's most effective is through cumulative knowledge build. Being out in the marketplace, visiting companies, getting to know businesses, getting to know the people who run those businesses, getting to know the characteristics of those businesses, and then find situations where there's a disconnect between the valuation that this business is trading at. And it could be all sorts of reasons why companies get disconnected from what they're worth. Or very simply, maybe the company never revalues, right? Maybe you hold on to it and, let's say you bought it at a low multiple, 8, 10 times earnings. Earnings don't really grow, right? But the company generates a lot of cash. Hopefully you at least got that right. And the cash is being given back to you. You're earning a 10 to 12.5% earnings yield on your investment. And, there could be worse things in the world than earning a 10 or 12.5% return on your investment. So, value investing, it really does have a lot of benefits to it. And fortunately, despite, Buffett and Munger's efforts to, preach the benefits of value investing, there are still very, very few people who do it.
Absolutely. And you talked about this sort of disconnect. When you go around, you look at the businesses, there's a disconnect between what the market's pricing and your estimation of intrinsic value. And earlier you talked about how Columbia and other academic institutions have really bought into efficient markets hypothesis. So, so how do you know that the market's not right, and you're not just entering some kind of value trap? And or put another way, why would the market underprice something if the intrinsic value is so attractive?
Well, the only way to know that you're right is to do research, right? We're fundamental investors, and we spend just about all of our time analyzing businesses. And over time, you learn the difference between a good business and a bad business, and a good management team and a bad management team. Um, there are things, by the numbers, so to speak, that are easily identifiable, right? The rate of growth, the market position, the profitability, the moat around the business. By the moat, I mean the ability to protect your market position and your profitability position. All of these things, in many cases, not all, in many cases, all of these things are analyzable, and along with, the duration over which you believe those characteristics will continue. There are many securities that we look at, which I think you're referring to as value traps, where the business used to be great, but something changed and it's no longer great, right? And the onus is upon us to identify the difference between that situation and a situation where there is some temporary impact on a business that is causing the stock market to sell it. Now, as you know, with all the experience that you have, and having spoken with so many market observers over the years, the stock market is not driven necessarily by economics, right? The psychological impact to the market is dramatic. People are greedy, people are afraid, and it is that period when people are frightened where they push the price of a security well below value is where we come in. That's where we can end up finding a security that trades at 10 times earnings that's worth 20 times earnings, right? Because people are afraid there's some temporary impact to the business, or there's any impact to the business, or there's an obsession with something else, right? That's another interesting way that people leave securities behind. There's an enormous pool of capital that loves to invest in what's hot lately. How can I make money now? And it is that push that causes capital to flow oftentimes to a certain part of the market, and perhaps another part of the market it's not playing, right? It's not directly associated with that area, or there's something wrong with that area, and that part of the market is not getting any capital. Um, and you can see it. You can see it in some of these products. The proliferation of high technology ETFs. What does that mean? Well, what that means is that there's a lot more money flowing to any company that is deemed a technology business, right? And who deems it? Well, it's whoever is designing these ETFs. It doesn't have anything to do with the fundamentals of the business. They're designing a product. That product is to be promoted. That product is to be sold, and assets are to be gathered in those products. And that will attract a lot of capital from non-technology businesses, for example. I don't mean to pick on technology companies. I do own some, towards technology businesses. And that oftentimes creates a serious disconnect between, and there can be nothing wrong with the businesses. They're just not receiving any capital. And that's the beauty and the wonder of the public equity markets.
Absolutely. Now, you mentioned quality of management, and I'm always intrigued by that. I've run my own company. I've worked for lots of other companies, and when you're inside, you have a good sense of good management and bad management. But in your eyes, I mean, what are some of the qualities of good management versus, say, bad management? Like when you go in, when you meet the management team, when do you go, oh, this is a great management team?
Well, if I just sort of approach that question from the opposite angle, what defines a bad management team, right? I think being self-serving, and there are many, many ways, protecting your job, paying yourself in ways that aren't linked to performance, hiring leadership at the second level that does not challenge you in any way, having misguided objectives. We've had leadership that were so focused on ESG, they were ruining the business, pursuing an objective that was going to result in, effectively the business being impaired, which would have impaired their business to pursue that objective. Bad capital allocation. It's always tempting for an intelligent, energetic person with a large pile of capital to do something with it, and there isn't always something intelligent to do with it. Oftentimes they'll use, and this goes together with people on the board who aren't really well equipped to think through capital allocation. They'll do things formulaically with excess capital that don't make any sense. You see that a lot in share repurchases at very high valuations, which make absolutely no sense. It's just a formula. They just keep going on and on and on. There's no thought behind it. So there are many, and bad acquisitions is sort of the defining moment where a CEO shows their lack of commercial and return-based acumen. So those are the things that define a bad management team. Not investing to promote and grow the moat around the business, right? Not spending the capital to find new innovations and new ways to grow, over diversifying the business into fields that the company doesn't have any level of expertise and doesn't have any competitive advantage. Holding on to employees just to hold on to employees. They don't have the willingness or the ability, or sometimes even the legal or cultural influences to be able to right size the business, to place profitability in a position that would normally be dictated by a company in that industry. And sometimes it's not management's fault. Sometimes it's there's a controlling shareholder, and that controlling shareholder will have different objectives, and they're hiring people that will operate the business under those objectives. There could be a board of directors of people who aren't focused on the right things and pushing agendas that aren't necessarily in the interest of the minority shareholders. So it doesn't necessarily mean that the people who are running the businesses don't have the talent or capability to run it well, but they're just operating under a set of incentives that emphasize other things than achieving the best level of growth and profitability in the interest of the shareholders. So what we mean by good management is the opposite of all of those items.
No, that's great. That's fantastic set of points that you make there. You did mention moat, and one of the things I always find with the concept of a moat is, of course, it makes a lot of sense, but I always wonder or think about the innovator's dilemma, Christensen's innovator's dilemma, where, the moat works, it works until it doesn't. And meanwhile, you've basically built a whole business that's optimized for last year's environment. How do you think about moats?
Well, each business is going to have different characteristics associated with it, so it's hard to generalize. But I think the issue associated with the erosion of moats over time has made technological innovation has made protecting one's position much more difficult over time. It used to be that consumer brands, because of the value created in the mind of the consumer and the strength in distribution through the retail channel, would create a very, very high moat for companies that had strong brands. And to some extent, that still exists. However, over time, the primary form of distribution, I'm just picking on one industry, the primary form of distribution has decided to compete with store brands, and that has become a very difficult product, especially given the relative price points, to compete with. The ability to distribute over the web has created a new dynamic, whereas in the old days you could pay slotting fees, and now you have to pay fees to Amazon or Walmart.com in order to make sure that whenever a search is done, your product comes at the top of that search, which is great, but it's a little different in terms of the cognitive impact that it has, rather than staring at a shelf where you've got a big display of a primary product because they're displaying that product. It's really easy to scroll through a bunch of blue links, right? And now we're even going beyond blue links, but it's harder for these brands to present themselves in front of the consumer and maintain that moat. And, that's happening, in the old days, you only had cigarettes, and now you've got, other ways of consuming tobacco. And then that's been innovated. Now you have other ways of consuming nicotine, right? Without the tobacco. And that level of innovation, and I think now with AI, you have the possibility that defining exactly what consumers want and defining exactly how to get to that consumer in even a more micro fashion, rather than the big, broad general appeal that brands used to have, is becoming more of a reality, and fragmenting the marketplace and creating the ability to have a very profitable, smaller brand focused on micro markets. That's creating a much more challenging environment to, selling mayonnaise.
Absolutely. And, I wanted to pick out, a few of the investments that you've made over the years, which I found quite interesting. One is that you have an investment in your portfolio, which you've held for, I think almost 20 years, I think it is Arch Capital. That's an awfully long time to hold, particular security. Why? And how do you think about something like that?
Well, Arch Capital is in a pretty mundane business, property casualty insurance. And a little like asset management, property casualty insurance requires a certain discipline on, where you're going to allocate your capital and what the return on that capital will be. And the company, it's been eroded a little bit lately, but the company has two distinct competitive advantages. Okay, so first, we bought it more or less on startup at a small premium to book value. And today it trades, at not much more of a premium to book value. Book value has gone from a billion to around 24 billion now. And the company's bought back 40% of the shares outstanding. So it's been a remarkable compounder to use sort of an overused word. And there are a couple reasons. So one of the wonderful things about investing outside the United States is it's the environment is even more diverse than it is inside the United States. And one of the ways that it has been diverse is the difference in tax rates. So if you and I were selling commoditized widgets and you had a 40% tax rate, which used to be the tax rate in the United States, and I had a 0% tax rate, it's the same product. Well, I could take advantage of that in one of two ways. One, I could lower my profit margins by lowering price and still earn an adequate return on equity and take market share from you left and right? Push you into a position where your returns are very low, you find it hard to finance your business, and I can continuously take market share. Or in the case of Arch, where they operate in a highly fragmented business, they earn a higher ROE, right? They are selling the same product at the same price as everyone else. However, they're earning a higher return. Now, that's very interesting. Now, if you compare that, so first of all, insurance, if you do it right, is an amazing business, right? You're getting your premiums up front. You put that in the bank, it starts earning a return, right? And then, you have some losses, you pay your administrative expenses, and even the losses that you incur in any given year may or may not be paid out in that year. And for most of insurance, the tail or the duration over which those losses are paid out can be 3, 4, 5, sometimes 10 years. And that money continues to sit in the bank and you earn on that money. Now, the person who does this best is Warren Buffett and Ajit Jain at Berkshire Hathaway, for two reasons. One is Ajit is a very talented and disciplined underwriter who in most years, generates an underwriting profit, right? So that means not only do people give you money up front, but they're effectively paying you to take their money, right? You earn a profit on that money. And then when Warren and Charlie put that money to work, they can earn very good returns on that capital. Now, Arch Capital isn't, the CIO is very talented and she's great, but most of the money is invested in very low risk investments. But the difference between Berkshire and Arch is the tax rate. So you can earn, 200, 300, 400 basis points per year lower, but on an after-tax basis, you're earning something closer, right? So, and in terms of underwriting profit, Arch Capital has something that I haven't seen at any other listed property casualty insurance company, which is their incentive compensation scheme. The old CEO of Arch Capital, the now deceased Dinos Iordano, used to refer to insurance as a self-grading exam. So if I'm Dave Samra and I'm a property underwriter and I'm underwriting, let's say, a liability policy for company ABC, I use my actuaries. I come up with the level of rate to charge my customer, and I estimate what my losses might be on that contract, even though those losses may not be paid out for 3 or 4 years. And then I come up with my estimate of profit, right? It's a self-grading exam. And most underwriters are paid on their estimate of profit in that year, whereas at Arch Capital, the underwriters are paid on the ultimates, meaning that they have to wait until the profit is actually determined and then their bonus is based on that actual profit. Now that's a huge, huge difference between what Arch does and what other companies do, because there is zero incentive to show a huge profit in the first year. Zero, right? And the company, as a result, will pull the pen, so to speak, will not underwrite premiums in a year where rates are not satisfactory, but will underwrite a lot of premium in years where the rates are satisfactory. Now, if you compare that to other companies, if I'm going to get paid on my self-grading exam, I want to write as much premium as I possibly can, no matter what the rates are, because I'm going to make money. And that's a huge difference. And that has allowed that company to compound its book value. And because, insurance is an inherently levered business, and, people tend to compare multiples in the industry across, it's occasionally got up to a level of, two-ish times book value. But generally speaking, it's traded between 1 and 1.5 times book value for almost the entire holding period. And I found that level of valuation to be undemanding and not representative of the unique characteristics of this business. And as a result, I've just held on to it over the years, and it's worked out quite nicely.
No, that's great. I've also noticed another thing that you've done over the last 4 or 5 years, at least, perhaps you've done this earlier, is that on occasion you've used the tool of activism to influence the direction of the company, which I haven't heard as much of from value investors. Often they just sell their shares and you use that. So what was the motivation for doing that? Has it been successful when you have deployed that?
Well, I think, as you generate or get more experience and you build cumulative knowledge in this business, it helps you better utilize the tools that are available to you as minority shareholders. There are legal rights that you have as an owner, and that's how we think about all the investments that we make, that we are, we don't look at stocks as pieces of paper to be traded. We think about them for what they legally are, which are small pieces of ownership in a business that has some level of enduring value. Now, you have a lot of different constituents in a publicly traded company, not the least of which are other shareholders. And sometimes, the board or the management, can start doing things that are not in the best interest of the shareholders. And, ever since we started way back in 2002, even when we were smaller, we would tend to, focus our capital on a few investments, and some of them were very small, and we were very large shareholders. And management, would pile up capital unnecessarily, or make a bad acquisition, which led us to believe that, perhaps we didn't have the right leadership. And we would exercise our rights as a minority shareholder to try and change that system. Now, we today manage over $50 billion. And, if you think about a 5% investment, you're talking about a $2.5 billion investment in companies outside the United States. Now, there's plenty of liquidity in the stock market inside the United States, but the level of liquidity in stock markets outside the United States is much lower. And as a result, you end up with a $2 billion investment having a very large ownership interest in many of the companies in which you invest. And if something goes wrong, right, you have to start thinking about what your alternatives are, because selling $2 billion worth of stock and then finding a new $2 billion investment is a daunting task. It's not simple. especially when you have a very tight discipline in the way that we have. We're looking for companies that have four key characteristics: an undervalued security, a good business with a strong balance sheet, and a good management team. And let's say we get something wrong. Let's say the management team turns out to be, not what we thought it was, or they have other influences that are changing their behavior. Instead of having the flexibility to sell and move on to something else, we might want to consider what we can do in order to change that trajectory. And, it normally starts with a conversation with the board, with the chairman, or the CEO. And I would say the normal course of action is for either one of those two to just say, "Oh, great, thanks for the advice," and dismiss us rather quickly. And then, you call them back and say, no, we were serious about this and you don't seem to have paid any attention to it. And they'll say, "Oh, yeah, okay, we'll start paying attention to it." And then we'll write a letter. And we'll write a letter to the whole board. We'll, of course, study who is on the board and try to find some sympathetic ears and start the process of helping the company see things the way that we see it, right? It's not always that they're doing things, just to beat up the minority shareholders. Sometimes that's done, but very rarely. It's just they don't see it in the same way, or they don't see it at all. And sometimes you have to open that shutter so they can see properly out the window. And sometimes it takes longer to get other people to see it because there's some other constituency on the other side that's whispering something else in their ear. And generally speaking, we can start a dialogue in that way and quietly get things done. But sometimes, more dramatic things are necessary, and in order to enforce our rights as minority shareholders, we're not afraid of protecting our investment, right? We're here working on behalf of the shareholder, and we want to protect our investment and maximize our returns over a long period of time. And if we have to really engage with the business and we don't, with the company, and we don't love to do this, it takes a lot of time that could be spent, doing other things. We're not afraid to do that. And it is a tool that we've developed over many years. And that tool has become more important to us as we grow in size. And, we have more of a limited ability to trade in and out of securities, and our universe is narrowed dramatically.
And you mentioned $50 billion is the assets you have under management. I mean, what constraints does that provide you? I mean, one, you sort of mentioned the size of investment is such that it's not so easy to get in and out. More generally, what are the sort of challenges one has with such a large AUM?
Well, the challenges are kind of obvious, right? I mean, the larger the asset base, the narrower your universe. You have less to choose from, and your opportunity set becomes more episodic. So during big drawdowns, it's way easier for us to deploy a significant amount of capital. And in time periods like this, where the market seems to get excited about every little, piece of new information, we do a lot more selling than buying, and redeploying that capital in any significant way in new undervalued securities becomes much more difficult, right? So, capital is the enemy of excess returns. It's very, very hard.
Yeah. And, we've sort of touched on tech a number of times in this conversation so far. That's been such a big theme over the past year or two, especially the larger big tech US companies. And it seems like they're just driving all returns. There's talk of AI bubble and so on. And everything is being stamped with AI on top of it to get those flows coming in. I mean, what do you make of this stage of the cycle that we're in? I mean, are we in a dot-com phase like the late 90s, early 2000s? Big tech, their balance sheets seem quite solid, so that seems one important difference. What do you think about all of this?
Well, we have been able, there are a whole bunch of dimensions to this, right? There are perceived AI losers, there are real AI losers, and there are perceived AI losers. And that has become, an interesting area for value investor to hunt in. There are also disconnected thoughts around valuation. So, for example, prior to its recent run-up, you had Alibaba. Now, you clearly, as a U.S. investor, you clearly have risk, geopolitical risk, associated with investing in Chinese equities in a big way. However, prior to the recent run-up, you had a core e-commerce business which was still growing slowly, that was valued at 5 or 6 times earnings. And what you basically, so backing out cash and investments, but basically what you got in addition to that was one of the largest and the most capable and dynamic cloud business in China, and one of the largest large language models in China called Qwen. And you had OpenAI at a valuation of 200 billion versus Qwen, which in the second largest economy in the world, valued at 0, right, or arguably negative value, right? So you can find these situations where there's a big disconnect between relative valuations. Now, we don't tend to think in relative valuations, but 0 seems a little extreme to us. And so, you have opportunities, there's a whole new industry, right? Maybe these LLMs sustain very high levels of value, or maybe they become less valuable in the US market than where they are, but it looks like they will be foundational models and they will have an ongoing revenue and profit stream that could become very, very valuable. So 0 seemed to be too low. In terms of the sustainability of what's going on in the United States, and we don't invest in the United States, so it's very hard to comment, but I will provide one observation that's been sort of cascading around in my head, and only time will be a proof point to this. But it's really interesting that there are 6 or 7 of these broad scale large language models, right? And in order to operate these models and generate, the promised productivity, requires an enormous amount of capital, right? You need these very, very expensive data centers. That's why you see OpenAI, first raising capital from Microsoft to doing a deal with Microsoft. Of course, Microsoft has Azure, which is a big data center, business. So it offers them great distribution and great capacity, right? Google, Facebook, they generate huge amounts of free cash flow that is being used to build these very capital intensive data centers. Oracle is spending money like they never have before. And it's really interesting to think about, software and search engines and social networks. And one of the defining characteristics of these businesses is that they're low in capital intensity. They're very high return on capital businesses. They're very valuable. If we go back to EVA, right, they're very valuable. And, when those markets developed over time, of course, there were several participants at the beginning. But as time went by, you had a couple of scale businesses that, ran the board, right? Took a lot of the market share, whether that be Facebook or Google. And that kind of changed the complexion of, U.S. commerce, right? Very high return on capital, much higher than it had been historically. If you go back to the era of railroads, for example, right, where you had this big boom and it was very capital intensive, you had some very high valuations, but eventually it turned out that, not everybody could compete, in on the same line and generate sustainable returns over time. And I'm not saying, I don't know what the eventual outcome is here, but we're entering a period in technology where the capital intensity is so high that it is possible that we end up with businesses that have much more mundane return on capital than what we have had. We all have recency bias, right? It's just one of these things that we have. And we could be entering a time period where those returns are much lower. And I think that there's a possibility that that has, some impact on where valuations go in these businesses over the course of the next, 5-10 years or sooner.
That's great.
If people really realize what's going on.
Great observations there. I did also want to ask you about private markets, because obviously that's been a huge growth area: private equity, private credit, private, anything and everything. And at the same time, public listings have been going down. So it seems like a lot of capital has moved into private markets, and asset allocators seem to quite like private markets. And what are your thoughts on private?
Well, I have a lot of thoughts about this. I generally find the use of significant leverage to be detrimental to commerce in general. I think things are done to be expedient rather than to build value over time. I have no issue with private companies whatsoever, but I think in the hands of private equity, where they're purposely using leverage to try and magnify their returns, you end up with a large chunk of commerce in the United States, perhaps not wisely investing in the duration, of their businesses. I find private credit interesting in that initially a lot of the changes that were made to risk weightings for banks post the great financial crisis sort of disintermediated the banks from lending to certain types of companies and certain companies of certain size, and that created an incredible opportunity for other lenders to go in, and it looks like it's become awfully big, and it's probably taken on, in my view, too much of a life of its own, and not all loans go well. If you look at the BDCs, there's all of them have a certain percentage of their portfolio that are PIKing, and that's sort of ridiculous, especially since those investments are made on leverage. So there are problems within private credit. I think perhaps if there's some deregulation of the banks, there'll be more competition, which in an asset accumulation business, that could be a problem. But generally speaking, I think, the original intentions and much of the business that they're doing is pretty good business. They were arbitraging, it was regulatory. It was almost like reverse regulatory arbitrage. And it was a great idea, and you can earn high returns. I think that the products, Wall Street creates products, right? I mean, I'm a product of that, right? We have a product, and I like to think of ourselves as an investment platform rather than a product, and that's the way we behave. And we have all of our own money invested right alongside our clients. So we behave like an investment platform, but effectively we are treated as a product. But just getting to the public market part of your question, I find, a lot of mutual funds I used to consider products because they were mimicking an index, and now ETFs are indexes, and they proliferated like mad. And these are products. These are not investments. And the way that wealth is managed in the United States by wealth managers feeds, straight into the use of these products. And so people don't own investments anymore. People own products. And I don't think that that is generally good for society. And, that whole, the gamification and the gamblification of the stock market is pretty unsettling in terms of the way people think about what the stock market really is. So I can see why if I owned a successful business privately, I might not want to enter into that realm. Private equity has been very powerful, and a lot of companies have been taken private and delisted because somebody comes and makes you a good offer. So there have been a lot of factors. That said, if you asked me today if I would rather invest in the public market versus the private market, on an aggregate basis, you still have incredible inefficiencies in the public. In private markets, you have a well-informed seller, right? Always the person who owns the business knows the business way better than you will as a buyer. You also have illiquidity. You can't get in and out, right? If things are going wrong, and generally you have almost no rights as a minority shareholder, right? So let's say you're a shareholder in one of the LPs of KKR, and something's going horribly wrong in the business, and the largest investment, and it needs a new CEO. You're not going to pick up the phone and call Henry Kravis and say, "Hey, Henry, what's going on here? I'm going to make this very uncomfortable for you until you change out the leadership here." You can't do that. Now, Henry's incentives are aligned with yours, right? So maybe he'll do that if he's paying attention. I don't mean to pick on him, but I have all sorts of private equity people out there. Whereas in the public market, it's driven by fear and greed. It's driven by the insanity of human behavior. And that creates, unlike private markets, an opportunity to get involved in some extraordinary situations where, people are focused on the wrong thing. And you can find securities like, the example that I gave with Alibaba, where things are so absurdly priced and the odds are stacked so high in your favor that you can allocate serious amounts of capital to securities and be in a very, very beneficial position. And I just think that that's harder to do in private markets. And look, if it goes wrong, you could sell it, right?
Absolutely.
And you can move on.
No, those are great points. Now, I did want to sort of round off with one or two more sort of personal, low-key questions. One is we do have some youngsters listening to this podcast, people in college, they're going to graduate this year, this academic year, or have graduated. What advice would you give them as they enter the real world?
Well, I think finding something that you are very interested in, finding an occupation that you love and that you can excel at is what is going to make you happy. You get up every day and you work 8, 10, 12, depending upon what you're doing, 20 hours a day. You need to like it. The second piece of advice I would give any person is to spend less than you earn. Always be strong, what a friend of mine calls strong money, right? You never want to be in a position where you're reliant on the good nature of others in providing you with capital. You never want to be in that compromised position. You never want to have so much leverage where it can financially ruin you. So if you spend less than you earn, you save, you invest, you be strong money throughout your life, you're going to get a lot of happiness out of that. And the other thing is it is be good to others and be humble. The world is complicated. We're all in it together, and you could be the smartest person in the room, but you're not going to get a lot of benefit out of showing that off. So I think being humble, try not to be envious of what other people have. Focus on what you love and spend less than you earn, and I think you're gonna have a pretty good life.
That's fantastic advice. And then I noticed you mentioned earlier a book, Quest for Value. What are some of the books that have influenced you of your career?
Well, The Intelligent Investor, I still find new things in there that are insightful to what I do. The Money Masters, if you're interested in the money management business, Money Masters by John Train, which takes you through the philosophy of different types of investors. Phil Fisher is the, preeminent historical blue chip growth stock investor, is featured along with Warren Buffett. Those are fantastic books. And then there's one author who I've been dedicated to for decades. I read everything that he puts out, but it's fiction, so it doesn't have anything to do with work. His name is Mark Halperin. I think he's a great writer. I find his books to be fantastic. And his best book is called, in my view, and it's very funny. I like things that make me laugh, because I spend most of my time doing very serious things. And so there's a book called Frederick and Frederica, again by Mark Halperin, and it's a fictional tale about British royals who eventually, take over leadership of America. And it's a very funny tale. You'll very much enjoy it, and I would recommend anybody to read anything that Mark puts out.
No, that's great. And then final question, David, what's the best way for people to reach out to you to learn more about your thinking and so on?
Well, I think, first watch, podcasts like this one. There are a few of them that are out there. I have a whole history of shareholder letters that are on the Artisan website. www.artisanfunds.com, I think is the link. And there are some, there are a few things on YouTube, but there's one in particular that was recorded. I don't know why it ended up on YouTube, but it was done internally for our clients, on the difference between investing in the United States and outside the United States. I don't know that many people perceive or understand what the differences are. You are in a different time zone, right? And many people in different time zone don't speak the same language. Okay, so let's just start there, right? As some very significant differences, but it gets far more complex than that. And I think for anybody outside the United States who's contemplating, because markets tend to be smaller and fragmented, so you might be thinking of investing in many different marketplaces. That might be an interesting area, to spend some time thinking about, where you're allocating your capital and truly what you're getting involved in.
No, that's great. I'll make sure to include the links to all of those as well. So with that, David, thanks a lot for the fantastic insights and good luck for the rest of this year and beyond.
Thank you for having me.
Thanks for listening to this episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'll be very, very grateful. And of course, sign up for our free newsletter at macrohive.com. And this podcast is not intended to be investment research, nor does it constitute financial, economic, legal, tax, or accounting advice. This podcast is provided for information purposes only and does not constitute an offer or solicitation to purchase or sell any financial instruments. The contents of this podcast are not based on your individual circumstances and should not be relied upon as an assessment of suitability for you of a particular product, security, or transaction. The information in this podcast is based on generally available information and although obtained from sources believed by MacroHive to be reliable, its accuracy and completeness are not guaranteed. Past performance is not guarantee or indication of future results. Third-party opinions expressed in this podcast are solely those of the speaker and do not represent the views of MacroHive, BGC Group, or any of its affiliates. And this podcast may not be copied or distributed in whole or in part without the express written consent of MacroHive. All rights are reserved.